Thank you so much, everyone, for joining us for today's presentation. This is Accounting 101 for Investors, Part 2, because Cherry had so much amazing information and just provided so much value when we met a couple of weeks ago that she very kindly agreed to come back and spend some time with us today and share the second part of her presentation. So just a little bit of housekeeping. Our agenda for today, we'll do quick welcome and introductions. I'm assuming everybody who's here probably knows who I am and probably knows who Cherry is, so we're not going to spend a lot of time doing that stuff. Probably about 45 minutes of great information and content today. There'll be a Q&A session at the end, and then I'll do a quick webinar wrap up. We are aiming to finish around 1 o'clock so everybody can get back to their busy days. So I, of course, am Elizabeth Kelly. I am your host for the webinar today. And joining us, of course, we have the wonderful Cherry Chan. Thank you so much again, Cherry. I know how in demand you are, and we're coming up to your really busy season. So I really appreciate your time and dedication for coming back and finishing your presentation. Cherry, of course, is an extremely successful accountant and probably, I would say, the preeminent accountant of choice for savvy real estate investors, especially here in Ontario, but all across the country as well. Is there any territory or any area you can't do? Can you do Quebec as well? Can you support people in Quebec?
I wish I can, but I don't want to learn a different language, and that's why I stopped there. Okay, Quebec, I'm just going to exclude you guys. Not that this doesn't apply to people who live in Quebec. It's just that I can't do it myself.
And that's fair, to be honest. I mean, you know, as savvy real estate investors, it kind of helps to stay in your own lane and not try and be an expert of everything, right? So we really
absolutely
respect that very much. And so, Cherry, would you like to take over and get started?
Yes, absolutely. Thank you so much for the introduction. So can everyone see the screen right now?
I can.
Okay, so it's the full screen, right?
Yes.
Not showing my. Okay, sounds good. So I'll get started. Thank you so much for attending. I think every one of you would have, like a lot of you would have already gone into the previous recording, have watched the previous recording or watched the previous webinar live. But I'm still just going to quickly introduce myself one more time, just in case you didn't. My name is Cherry Chan. I wrote these two books. One is The Complete Taxation Guide to Canadian Real Estate Investing, which becomes had become the Amazon bestsellers list. And if you sign up using this link below, realestatetextips.ca/investors, you will get a copy of this book for free. So make sure you go to realestatetextips.ca/investors to download a copy of this book for free. Now, I'm also on different social media channel. I have my own website, which I produce a weekly blog. And if you want to receive tax tips on a weekly basis, you can go to realestatetextips.ca to sign up for it. And I am on Instagram. I am on Facebook. I also have a YouTube channel sharing different tax tips as well. So if you are your user of these social medias, make sure you give us a follow so then you can stay on top of the latest tax tip. Now, last time we talked about the bookkeeping essentials for real estate investors, and we talked about the Canadian tax system. Now we're going to talk about the 6 questions to decide whether you should set up a corporation or not. I know I started off I had covered a couple of sections on this particular topic last time, but I'm going to restart this whole discussion, and we'll go into common corporation structure as well. Now, I'm going to ask you guys to save all your questions until the end to ask, because I also have a FAQ slides, a few FAQ slides to answer some of the most commonly asked questions. So if you can save all the questions until the end to ask, that would be perfect, so I can have all the questions answered. Now, a little bit of a disclaimer to start off. I am an accountant, but I'm an accountant for a lot of people, but I'm not an accountant that understand your situation per se, because I may or may not know you. A lot of the time, accounting advice is purely based on your objective, your goals, as well as your personal situation. So that's the reason why I always have a disclaimer up front, and make sure that you consult with your accountant that knows your particular situation. If you don't have an accountant, we're always open for more business, but I'm just saying that the presentation presented here is it may or may not be applicable to you. So don't just take my presentation and apply everything without really understanding whether it's useful for you or not, or applicable. Now let's get started. How to invest in corporation efficiently. Now, last time we discussed this, our personal tax system is a progressive tax system. Essentially what it means is that the more money you make, the more tax you have to pay. Now, if you look at the whole tax system, we are on this marginal tax system. Essentially for the income between $0 to $13,000, for the first $13,000 income, you don't have to pay much tax, except maybe Ontario, it will be like a small amount of 5% tax. But $13,000 to $46,000, you pay 20% tax. The chunk between $46,000 and $50,000, that $4,000, the delta between the two, it's subject to 24% personal income tax. The chunk between 50K to 92K is subject to 30%. So the biggest misconception that real estate investors or Canadian investors would have is that we always talk about the marginal tax rate. What you see in front of you is the marginal tax rate. And they typically tend to apply the marginal tax rate to the entire income. But the reality is, this is just marginal tax rate. This 30% is only applicable to the income between $92,000 and between $50,000 and $92,000. So our marginal tax rate actually go all the way up to 53.5% in Ontario for any income that you've earned over $222,000. Let's say 1 year you have a base salary of $222,000, and that year you sold a property, and that property is sold for about $50,000 taxable capital gain, because only 50% is taxable. So taxable capital gain of $50,000. That additional $50,000 is subject to 53.5% tax because it is all over $222,000. So that's what it really means. To give you a practical example on how this whole thing applies, for someone who earns an income of $150,000 based on the Ontario marginal tax rate in 2021, you can see that I need to go through each tax bracket, take $0 between 0 and $10,880. There's no tax that it's being applied for that chunk of income. And then I go through every single marginal tax bracket and multiply by its respective marginal tax rate to come up with the tax payable on that particular tax bracket. And then I sum them all up, and that comes up with, at the bottom, the $45,000 of tax payable at the end. And this is how you come up with your tax payable. Now, why is that important? Because if you get a bonus of $50,000, it could be substantial amounts. You're not looking at your lower marginal tax rate. You're looking at the higher marginal tax rate. In our situation, for someone who makes $150,000, if your employer were to give you an additional $50,000, that additional $50,000 bonus is being taxed between a small amount, $2,000 is taxed at 45%, and the rest of it primarily is taxed at 48%. So even if you make an additional $50,000 bonus, you're pretty much only keeping $25,000, half of it, because the other half goes to CRA. Now, it's important because then you can look at the corporation tax system and then make a comparison. And the corporation tax system works completely differently. For active business income in Ontario, it's subject to 12.2% for small businesses. For large business, it's subject to 26%. Now, small business includes net income that you earn after tax from active business. And what is active business? Basically everything except small specified investment business income. Now, what is specified investment business income? Specified investment business income includes rental income, taxable capital gain, dividend income, royalty income, and interest income. So all these traditionally typically real estate investors traditionally describe these income as passive income. So all these passive income are considered specified investment business income. And once it falls under this category, it is being taxed at a different rate. Now, remember, active business income is everything except as specified in this particular definition, specified investment business income. So specified investment business income is taxed at 50% first. Out of the 50%, 30% is tax refundable when you declare a taxable dividend to the shareholder. So 50% minus the 30% that's refundable. So net pay over time in your corporation, you pay 20%. Now, when you issue a taxable dividend, what does that mean? When you issue a taxable dividend, it means that the shareholder of the corporation, which is you are the shareholder of the corporation, receives dividend. And when, just like when you invest in TD Bank or RBC in the market, stock market, when you receive taxable dividend from TD Bank or RBC from in the publicly traded market, what you are going to get at the end of the tax year is that you're going to get a T5 slip. A slip that indicated, oh, you've received $1,000 dividend or a $10,000 dividend. Same principle applies to a company that you own directly. So at the end of the year, you are required to file the T5 slip, issue a taxable dividend slip, T5 slip, to the shareholder. So as the shareholder, as the individual receiving the dividend that's taxable, you're required to enter this T5 on your personal tax return and pay tax on it. Now, shareholder has to report that dividend as personal income tax on your personal income tax return, and shareholder would have to pay personal tax. Now, so in other words, what it means is that the total taxes paid between the corporation and the personal dividend tax would be the corporation tax rate of 20% plus the personal dividend tax that you would have to pay on the dividend received. Now, many people would then question, like, am I double taxed because it's already got taxed once in the corporation and then they get taxed again in my personal name? So wouldn't I get double taxed? Technically, that's not true because our system is designed, the Income Tax Act and our income tax system in Canada is designed in a way that when you whether you own it in your personal name directly, own everything in your personal name, you would then pay all the taxes all in one shot. And there's only one personal tax liability. That personal tax liability would equal more or less the same as if you own it in the corporation, plus and declare the taxable dividend in the same year, everything out. That amount, the personal tax under personal ownership would equal more or less the same amount as if the personal tax plus the corporation tax combined if you were to own it in the corporation. So then your question would be, well, like, why would you set up a corporation if that's the case? And also another thing to point out is that when you are receiving dividend from your corporation, you are receiving dividend and the tax rate being applied to the dividend received is based on, it's a little bit less than what you would otherwise see in the regular income column. So if you're receiving dividend from publicly traded company, this is the column. The eligible dividend column is what it's being taxed on. The non-eligible column is what is being taxed on for companies who are issuing dividend from specified investment business income. Now, the reason why you would still set up a corporation is because corporation in certain circumstances can help you save taxes if you structure it properly. Here are 6 questions that I usually go through with my clients when we help them to decide whether they should set up a corporation or not. Now, what is your investment strategies? Assignments, flips, land development, rent to own, and wholesaling, they are all considered income, business income. So when you sell an assignment or when you do a flip or when you do certain rent to own deals, if you do it as business, they are considered 100% taxable. The profit that you make from selling the assignments or the profit that you make from flips, they're considered 100% taxable. They are also not part of your specified investment business definition. So when you make them income from these deals, these transactions, 100% of the profit is taxable. But they are not part of the definition of specified investment business income. So it's not subject to 50%. It's subject to 12.2% inside the corporation. So if you are doing a lot of these assignments, flips, land development, rent to own deals, you report it in your corporation name. The profit is subject to 12.2% tax in the corporation. Whereas if you do long-term buy and hold, the rental income is subject to 50% first, 30% is refundable, and then you get, at the end of the day, the corporation pays 20%. So that if you are earning a lot of these, if you are investing in a lot of assignment, flips, land development, rent-to-own deals, or even wholesaling, you should set up a corporation because it can give you a significant tax advantage. Instead of paying the 12.2%, instead of paying the 53.5% in your personal name, reporting that profit in personal name, you are now reporting all the profit in the corporation's name, which would be 12.2% instead. Now, in terms of long-term buy and hold, there are specific reasons why you would still consider investing through a corporation. It's just that there are stronger reasons, immediately tax benefit, to invest in assignment deal, flips, land development, rent-to-own, wholesaling inside the corporation. Now, the second thing that I want to mention, because we talked about investing strategy, is that these types of deals, assignment, flips, land development, as well as wholesaling, on top of the income tax implication, there is also an HST implication. Although that isn't really the focus of today's topic, but there could be HST implication. You may have to charge HST on selling these properties as well. So those would have to be factored into your cost calculation. Just want to send out this as a reminder. Now, if your property sale is considered income, which is the case of flips and all these assignment things that I talked about, better to report it in the corporation because you pay less tax in the corporation. Now, do you want legal protection? Legal protection is something that people need to, a lot of people are concerned about. Many people say that, well, I don't care about legal protection because I have my home insurance policy. And sometimes you really don't know what your home insurance company does, because the home insurance company, whenever you file a claim, the first thing that they do is to make sure that you comply with all the small prints, the terms and conditions in your insurance policy. If you don't comply with, you miss one thing that you did not do unintentionally, you might lose out on your claim on your insurance policy. And if you own everything in your personal name, everything can be at risk. So imagine this big portfolio, big long rectangle. It is you, and you own everything in your personal name. Everything could be at risk. Let's say if you were sued by your business, then your rental portfolio could be at risk. If you get sued by one of the tenants, everything in your personal name could be also subject to the same risk. So you can see that you could be exposing your entire life to just a rental portfolio. Is that something you want to do? As long as you're comfortable with the risk, it's not the end of the world. Now, the second thing is, if you separate the ownership, imagine now that each little paper folder here in front of you is its own entity. So the rental portfolio is owned in a corporation. Business is owned in a corporation. Primary residence, we never own it in the corporation because you want to take advantage of the primary residence exemption. Stock portfolio has its own entity, or it's being invested in a different holding company. Now, the rental portfolio being sued, it's not going to affect your business, which is hosted in a second corporation. The stock portfolio, maybe it could be hosted in the held in the holding company, and it's definitely not going to affect your rental portfolio. So by having multiple corporations for different purpose, you may be able to you will be able to segregate the risk that from your primary residence, from your own personal saving. And that's the benefit of having the corporation. Now, some people even go as far as setting up a family trust, because then the trust ultimately leaves you most flexibility and gives you maximum protection. Now, the third question, are you planning to buy more than one property? So if you are planning to just buy one property, it may or may not be beneficial to set up a corporation, because corporation filing costs are marginally higher when you have more properties. And there is a fixed cost in filing your corporation tax return. But if you have 5 properties versus if you have 10 properties, that fixed cost is already absorbed in the first 5 properties. So it gets spread out more if you have more properties within the corporation structure. And also, like, if you are planning to grow, one thing is that by having multiple corporations, you may be able to take advantage of the mortgage rules as it stands right now. Some of the banks would not count the properties that you own inside a corporation or in another corporation for the qualification of mortgages. So sometimes some of my clients would purchase properties in one corporation with RBC per se, and then they set up a second corporation to purchase all the properties with Scotia directly. And so each corporation is set up to work with one bank so that they would not interfere with the mortgage application, and therefore maximize the number of properties you purchase within each corporation, and maximize the credit use, and you would be able to purchase more properties with a lender. And that's what some of my clients did. And that's the reason why, if you're just planning to buy one property, it may or may not make sense to set up corporation or multiple corporation just for one property, depending on the type of depending on the type of property that you're purchasing. Do you own another small business? What I mean is that some of you are a small business owner as well. You may have a consulting business. You may have a property management business. You may be doctors or dentists. Now, if you are already owning your small business in the corporation, the income that you're generating from your small business, they are primarily considered small business income, and their active business income. And guess what? Active business income is subject to 12.2%. Now, if you have to take the money out from your corporation to your personal name to invest, that means you have to draw the money out from your corporation to invest. You will then have to report dividend in your personal name to pay the personal tax. And as we saw earlier, the personal tax rate can be as high as 53.5%. Now, but if I don't take the money out at all and I invest within a corporation structure, I could have my business and then I could have my real estate holding corporation. If I invest within the corporation, I can just pay as little as 12.2% tax. So for $100,000, I could have 87,000. Can I do the math? $87,800 to invest. Whereas if I take that $87,800 to my personal name, then I would have to pay personal income tax. Essentially, if you flip a switch and think about it, you're using the money that you would otherwise pay to CRA as personal income tax to invest for yourself in your favor. So hopefully that kind of help you understand why there is a benefit if you own a small business in a corporation and you have excess cash flow to invest. Now, how much money do you need personally from your small business? That is the second part of my the determining factor. Sometimes I met clients and they said that, well, I really spend all the money. Well, if you spend all the money, there's nothing left from your small business. Chances are it doesn't really make sense to invest in the corporation. But if you have money, if you don't need all the cash from your corporation, you have excess cash available to invest. That is the way to go. Now, the last decision factor is, are you planning to leave the portfolio to next generation? As I get older and as my clients get older, we get a lot of questions about estate planning, leaving their portfolio to the next generation. And typically, when we try to make the plans for our client, it requires the taxpayer to do something called estate freeze. When we try to pass on our portfolio to the next generation, because we freeze the asset, the value of the asset at the time when we do the freeze. And by the way that we do it, typically that's also allowed by CRA, is to sell all our assets to the corporation on a tax deferred basis. And the corporation and the sale price is being settled with a promissory note, almost equivalent to a promissory note, but it is a preferred shares in the form of preferred shares. So when we do that tax planning, sell it to the corporation and issue the shares to the next generation, it requires a change of ownership from your personal name, if you own it all in your personal name, and you sell it to the corporation. And it has a change of ownership. When that happens, the Ministry of Finance the Ontario government wants their cut. So they want to get the land transfer tax when you change title from your personal name to the corporation. Now, the estate freeze would help you defer all the taxes and freeze the amount of taxes that you would have to pay, even if you were to pass away. The challenge is that you still incur a bunch of land transfer tax when you do the estate freeze. And the land transfer tax is calculated. At current fair market value of the property at the time of the transfer. So it could be a substantial amount given how crazy the market has gone up. And there's no one-size-fits-all solution. Make sure you understand your priority, your situation, and consult with someone that understands all these as well. Because you also, some people wanted to maximize the number of properties that they own. Some people want to just have a simple life. I only want to have 2 properties. Those situations are very different, and the solution that we recommend would be completely different from each other. Now let's go through some common corporation structure. One corporation can own multiple properties. This is the most common structure we help our clients set up. It's the easiest to set up. It's suitable for beginner. It's low cost to maintain because there's only one corporation tax return, one corporation to be set up, and it's low risk. It's involving low risk houses such as single family. It's best suitable for people who are grouping low risk houses together, such as single family home, RTO, student rental, small multi-units. But if you are doing, let's say you're owning, also investing in multiple student rentals and you want to separate the risk, we encourage you to have multiple corporations. There is no one-size-fits-all solution, again, because some people may prefer to have 5 properties in one corporation. Some people are totally comfortable having 10 to 20 properties in the same corporation. From a tax perspective, majority of the time, there is no difference. Whether you own your 10 properties in 2 corporations or 10 properties in 10 corporations, chances are the tax rate is the same. Unless that 10 properties require you to hire more than 5 full-time employees, and that would be the time that would having them all in one corporation would allow you to take advantage of the low tax rate of 12.2%. You must hire more than 5 full-time employees. You could also have one corporation to hold one property. This is best suited for people who are investing in large multi-units and commercial. I've seen a lot of my clients participating in deals such as having one corporation, one large multi-unit building, and there are multiple investors. Each of them issue shares, and they invest in one property. And specifically, the corporation is set up just for one corporation, one property, and it is the investment structure is very specific to that particular deal. So that could also be the reason why people use one corporation per one property. Also, I've seen clients who I work with, they would own one commercial plaza in one corporation as well. It's mainly for risk segregation purpose because, as you know, if you think that there is a chance that you may get sued by slip and fall, and chances are you would have that happen in your lifetime. So it's always best to have it in multiple corporations, especially with commercial property. 3-tier corporation, it used to be like really popular as Justin Trudeau announced the tax law change a few years back. This has become less and less relevant. The idea behind it is to have the property management company charging the real estate holding company the property management fee. By having 2 corporations, the property management company is able to report the property management income, which is not considered as specified investment business income, and it is taxed at 12.2% because it's property management income. So a lot of people early on in my career set this up, but then they are not using it properly. Sometimes a property management company is generating a loss, whereas real estate company is generating an income. So typically we don't recommend our clients using this structure just because it isn't executed as intended, so that it doesn't achieve the result that we had anticipated. And you may still have a payable for the property management company at the end of the year. So some people don't really like it. Now, the last structure is income splitting and estate planning with family trust. Like I mentioned before, you can set up a family trust owning the real estate holding company, and it can continue to purchase properties, and you and your family members could be the beneficiaries of the family trust. And this allows you to get access to the funds that you invested in your real estate holding company, but it also allows you to essentially give shares to your kids in the future as well. So maybe it is helpful for people who are considering the next step beyond what they already own and maximize the number of companies that they already have. The challenge of this structure is that sometimes the bank do not like to have a family trust as a shareholder. So they don't like to work with that. And so far, I've only seen one bank that's willing to work with family trust. So it gets a little bit more complicated if you have this structure set up. Now, frequently asked questions. One of the questions that I get all the time is, can I transfer my existing properties to the corporation? Well, you can transfer your existing properties to the corporation. And like I mentioned before, you would be thinking on the land transfer tax, but you would not, there is a Section 85 rollover to defer the income tax that would be triggered by selling the property to the corporation. So you don't have to pay income tax. And actually, it depends on the number of refinancing you have done, but typically you don't have to pay capital gain tax on the property that you are selling to the corporation, transferring to the corporation. The cost is mainly the land transfer tax. And then the cost is the early termination fee that you would have from your bank, because when you do the transfer, you also have to take care of the bank. The bank need to agree to the transfer. The third thing that it would trigger is the professional fees, which includes the accounting fees to fill out the form, to do the instruction letter, to tell the lawyers how this transfer can be completed. And sometimes this could be anywhere between $2,000 to like $5,000, depending on your particular situation. And then the lawyer fees as well to do the transfer, title change, as well as transfer under Section 85. So those would have to be accounted for. Next is, how many properties do I need before it makes sense to set up a corporation? Well, I hope I've answered that question from the very beginning. I hope I answered this question throughout my presentation. There is no one size fits all answer. Some people usually say, oh, you need to have 3 properties to make it make sense to set up a corporation. The reality is, you need to, if you are planning to buy those 3 properties and you want to maximize the benefit of owning them in the corporation, you should set it up today. Now, before you start owning these properties. But if your plan is to only own 1 property and it's a single family townhouse in Milton, then it doesn't quite make sense to necessarily set up a corporation, because that's the only thing that you own, and you may or may not be concerned about the risk potential. So chances are I may or may not set up a corporation under that scenario. So there is no one size fits all answer, just because your situation could be different. Using the same Milton townhouse as an example, if the money that you use from your Milton townhouse is coming from your self-employed business that you own in a corporation, maybe you should really own it inside a corporation structure, because you don't have to pay the tax to CRA as personal income tax. You invest through your corporation instead. So those factors come into play. It's not an easy decision to say how many properties do I need to have before it makes sense to set up a corporation. If your long-term goal is to buy multiple properties, you do it from the get-go. But if your long-term goal is to buy 1, then it doesn't make sense to set up a corporation. And then the next question is, how do I qualify for financing in corporation? Well, This is an interesting one. As a matter of fact, I am doing a client-only webinar for my clients this upcoming Friday that we are discussing how people qualify for financing inside the corporation. We have a panel of people from mortgage brokers to reps from different banks. I guess the words on the market on the street is that, oh, you can't qualify for financing in corporation. It is a lot harder. It depends on who you work with as well. It could be a little bit more challenging than going through the traditional mortgage broker channel. The reason is because a lot of these banks opted that are willing to work with a corporation. They opted not to work with mortgage brokers with corporation. They may work directly. As an example, I think Andre Meadows was part of Elizabeth Kelly's webinar in the past. He's a client of my other business, and he's a mortgage rep from Scotia. And it's just unfortunate Scotia is always investors' go-to bank almost. At least when I first started, that was the case. It was so easy to get mortgage from Scotia. But then working through the mortgage broker channel, they would not qualify as they would not agree to do financing in the corporation. But if you work with a Scotia rep, they would easily do financing in the corporation, which makes it a little bit interesting, to be honest. So, which also means that you would have to approach the bank sometimes one by one. So yes, it is a lot harder to get financing because you have to submit your information to TD Bank. You have to submit your information to Scotiabank. You then have to submit the information to, I don't know, Meridian. So depending on your particular situation, there is a way to qualify for financing in the corporation. And if you are still purchasing the properties in your personal name and you still want to own it in the corporation, as a last resort, there is a way to own it in the corporation. It's called, it's by ways of using a trust agreement. It's not always recommended by accountant. In the accounting world, we want it to be everything done with proper title in the corporation that provides maximum protection. Also easiest for us to do our financials, and easiest for accountant to stand in front of the CRA judge if there is any, if you ever get audited. So that's the reason why I always prefer to have everything in the corporation if possible. If worst case scenario, it doesn't work, there is another way to own it in the corporation. And then there is a question, my accountant says that there is no tax benefit to own properties in the corporation. Is it true? Well, as a matter of fact, I once had this post on Instagram advertising for something else for real estate agents, not for real estate investors. And some guy who self-proclaimed that he's a tax expert said that there is no reason to set up corporation. You lose money by setting up corporations to own the properties in the corporation. And I believe he's a tax expert. The reason is because all the professional development courses available in the accounting world will tell you, oh, there is no tax benefit to set up corporation to own properties. The reason is because of the tax integration rule that we had before. There is no tax benefit per se, but it does not always explain to you that, hey, maybe 1 year I declared taxable dividend to the shareholder for this much, and then next year I declare a little bit more next year. I could do dividend sprinkling to split income with myself, or I could do dividends sprinkling to split income with my significant other, and those are not accounted for when they come up with this type of comment. Now, the second thing is that people also often forget that, hey, like sometimes I own a small business. I use my small business income to fund the purchase of my properties. And they forgot to ask those questions. And immediately they said, okay, there is no benefit. Well, there is substantial tax deferral if I'm using the money from my small business to fund the purchase of my properties. Now, the third thing is, of course, they don't talk about mortgage because I work with a lot of investors. Majority of my practice is with real estate investors. And so when you set up multiple corporations, sometimes it helps with purchase, qualifying for mortgages as well. People don't often look into, most accountants would not look into these type of benefits outside of just pure tax integration. A plus B equals C. They don't look at that. So this is why it's irresponsible just to say that, oh, there is no tax benefits without digging into your particular situation. And that basically concludes my presentation. It's 12:42. I'm pretty much on time, as what I told Elizabeth Kelly before. So don't forget, if you have not signed up to my to get this free book, make sure you go on to realestatetextips.ca/investors to get your free book. And now I'm up for Q&A.
That was awesome. You were right on schedule too. That was great. Thank you so much. And for those of you that this is really amazing information, this is one of those webinars that I know I'll go back and watch again. So don't worry if you didn't pick up all the subtleties and the nuances the first time around. Feel free, you'll be able to go back and rewatch it either from the recording that's emailed or from my YouTube channel. Okay, so we have 7 questions in the Q&A box. Are you okay to scan through those quickly? So
yes, absolutely.
If anyone has questions that you'd like to ask, if you guys could do me a favor, don't put them in the chat box, please. They'll get lost. Put them in the Q&A box and we'll do our best. We'll cover them sort of in order of everything that came in. So the first question, David asks, what is a holding company?
So holding company has many different meaning. It's not quite specified in the Income Tax Act. The way that I define the holding company that I used in my presentation is a company that only owns real estate or only earns passive income or only owns shares of another company. It doesn't conduct any active business at all. So it doesn't earn any active business income. Now the bank defined the holding company differently. The bank sometimes only like to work with, actually a lot of the time, they only would like to work with a company that only earns real estate income, rental income. They don't like to work with a company that earns also combined earning consulting business income as well as rental income. So that's their rule. That's Bank of Canada definition.
Okay, so it basically just holds titles for properties.
Yes.
Gotcha. Okay, fantastic. And what is the typical cost for small business accounting per year?
Sorry, say that again.
What is the typical, it's okay, what's the typical cost for small business accounting? So I think you have a model where your clients have, instead of getting like one big bill at the end of the year, you actually spread it out, don't you? Which is really cost effective.
Yeah, so we do a monthly billing for our clients to do their annual tax return as well as ongoing consulting and support during the year. If you hold properties that are 10 plus, or minus properties, and it depends on the clients. Typically, our fees start with $2,500 for a corporation tax return and go all the way up, like depending on the number of properties that you have, as well as depending on bookkeeping, if bookkeeping is required. And so that would be the answer to your question.
Perfect. Okay. And someone here said, I have a consulting business corp. Can I use the same corp? I think you've answered that question really well.
Yep.
Kevin said, there's been recent discussion about a coming change to the inclusion rate for capital gains up to 75%. Do you think this is likely in 2022? Does this apply to corps as well as individuals?
If it does come true, well, that 75% inclusion rate increase has been around as rumor for the last 5 to 10 years, to be honest. The reason is just because they need something. They need to look like they've considered everything. So what it happened is hard to say because they need, I think the government really needs housing. So they need supply of rental housing. If they do the 75%, that would curtail a lot of people from getting into the rental market, as in being a landlord. So that would not be beneficial. But do you think this will apply to corporation and individual? This, if it's being implemented, it will be applied to both corporation as well as individuals.
Perfect. And I just want to caution here, because I know there's some great questions here, but I think they're fairly specific to people. So I just want to, I would be remiss as a coach and as an experienced investor if I didn't say, you know, sometimes it makes sense to just reach out and book some time with someone like Cherry who really knows her stuff to get that personal perspective to make sure that you're getting the information that is most applicable to your personal situation. Cherry's going to do her best to sort of provide some great information. But when you have stuff that's really specific, don't hesitate to hire someone who really is a professional and will provide the highest quality answers for you. It's kind of like asking a question on Facebook and you're going to get a lot of, you know, you'll get sort of a general response, but I don't know about you. I'd always rather talk to a pro. So Jerry, do your best. And if you feel the question is more specific, then they would be absolutely okay to just encourage someone to reach out to you directly.
Awesome.
Do you want to
go through the, yeah, okay. So Haiti is asking, if you buy pre-construction under personal and a property hasn't yet closed, can you still assign it to the corporation if it hasn't closed? Well, it gets a little complicated. So the reason why buying pre-construction under personal name and then you assign it to a corporation, it gets complicated because there is that HST residential rental rebate. And that is about $24,000. There was a court case that did exactly what you mentioned here. Essentially, the buyer purchased a pre-construction in the personal name and then use a trust agreement to purchase it in trust for the corporation. And then when that person apply for the residential rebate, rental rebate, they apply through the corporation's name. And CRA declined it, saying that, well, when you purchase the property, which is years and years ago, as you know, pre-construction takes years to complete, the corporation hasn't been set up. So I would be cautious when you do this type of assignment to the corporation. First of all, I would not do assignment because assignment carries a different meaning. Typically, you're making money. When you do assignment, I would make sure that I can do an amendment to the agreement of purchase and sale. Even as small as changing the terminology makes a difference, because right now they're going after assignment deals, right? They're not going after amendment. So if I would do it, I would do it as amendment. So that is my insight. You can do it. It's just that there may be some risk being exposed. David is asking ownership between non-resident. I don't think we cover this. We should cover this here. But if you are asking about capital depreciation in a corporation for property to minimize corporation tax burden, essentially you are always eligible to claim capital cost allowance. Capital cost allowance is something, I think that's capital depreciation using your terminology. But capital cost allowance is a tax deferral. It's not a tax, it's not a write-off per se. What it means is that you can claim the wear and tear as allowed by CRA's rate against the building. And the building, against building, the building would be 4% on the building cost. And you can write it off up to the maximum of the net rental income that you report. Now, but the year that you sell the property, you'll have to take all the capital cost depreciation that you've claimed, capital cost allowance that you've claimed into income. So let's say year one, you claim 5,000 of CCA capital cost allowance. Year two, you claim 5,000 capital cost allowance as well. Year three, you sell the property, and that 5,000 from year one, 5,000 from year two, the total of 10,000 capital cost allowance that you've claimed has to be taken back into income as passive income in the corporation. Now, in the personal side, that same 10,000 capital cost allowance that you've claimed would have to be taken back into income as rental income as well. You can use other properties' capital depreciation to defer some of the taxes, but I just want to make sure that it is a tax deferral, it's not a tax write-off. Naf is asking which bank is willing to work with family trust. It really goes back to your relationship with the bank. As far as I know, so far, Scotiabank is the one that's willing to work with, from my client's experience, not from my personal experience. Scotiabank is the one that's willing to work with family trust.
I think CIC is relatively open to them too.
Oh, cool. That's awesome. Brooke is asking to Cherry. Hi, Brooke. Nice to see you here. On why the 3-tier is not recommended today anymore. The reason is because of the tax on split income. let's see if I can see this. It depends on, there's a way around it, but the reality is there is tax on split income risk when the money is made from your related parties, related companies. They are owned under the same ownership, and that includes even if the property management company is owned by you, and then the real estate company is owned by your husband. So there is that charges, and then when you take the income out as dividend, the dividend income that you receive from the property management company can be subject to tax on split income, which is at the highest marginal tax rate in Ontario. That's why the consensus in the real estate accounting industry is that it's not useful anymore, property management. The reality is there are ways to get around it. You can pay yourself a salary, a reasonable amount of salary as well. So it gets a bit more technical and complicated. Hope that answered your question. Please explain what is the proper way to use a property management company in more details. I think if you own a property management company structure, I would encourage you to speak to your accountant directly because you set it up for a reason. So make sure that you speak to someone that knows your structure well, so then you can understand the ins and outs of how to implement this particular structure. Let me just go back to the Q&A slide, or actually follow me on social slide, that works too. Is the only difference between the different provinces the tax rate, or are the tax law corporate structure actually different too? No, the difference primarily is just tax rate. There are certain specific things that are different. That could be the land transfer tax, because Alberta has no land transfer tax. The last time I checked. I hope it still doesn't have land transfer tax. So it doesn't have land transfer tax, so then that could affect your rollover if you want to transfer your properties to the corporation. The biggest thing that's in Ontario is the land transfer tax, and all of a sudden in Alberta, there is no land transfer tax, and it makes the transfer a lot easier. So that could be some small tweaks to my presentation, but the tax rate is also lower in Alberta as well. So those are the primary difference. Andrea is asking, can you do a property management structure if you have properties under your own name? So that's a great question. I think I get those questions all the time. When you set up a property management company and you start charging yourself the property management fees, the answer is yes, you can do it, but then the money has to stay in the corporation. Otherwise, then you take the money out, and remember, when you take the money out, there is tax integration. You have to report it in your personal name, and then essentially the corporation pay the tax plus whatever you pay in terms of receiving the dividend income from the corporation. All these add up would be more or less equal to the same amount of income that you would earn in your personal name without the property management company. So there's no point to set up the property management company. However, if you do you're not planning to take the money out, you can shelter a portion of your income into the property management company. But then what are you going to do with the company? What are you going to do with the cash sitting in the property management structure, sitting inside the corporation? You're not going to get a lot out of it if you don't have the whole structure set up, or you're not planning to use the money that you save inside the property management company for investment purpose. What are the pros and cons of closing the incorporation? It might be hard to visualize the real estate investment strategy completely at the moment. Pros and cons of closing the incorporation. What do you mean by closing the incorporation? What are the pros and cons of buying the properties inside the corporation? I hope I used the whole presentation. You should rewatch my presentation. There are income splitting opportunities. You can save land transfer tax. And then there are, if you own small businesses, there may be tax saving, there's legal protection and all that. So hopefully that answers your question. If not, just rewatch the video. It's going to help you a bit. Who else? What is the tax implication if you have to sell one of your properties from your corporation? Well, the tax implication is the same as if you were to sell it in your personal name, most likely. except you get the flexibility of declaring the taxable dividend to yourself a little over a number of years. Still 50% of the if you are selling a properties that are long-term buy and hold, the profit that you make would still be considered capital gain. And then capital gain inside the corporation is still 50% taxable. The other 50% that's not taxable. The 50% that's taxable is being taxed at 50%. And then 30% is refundable because it's refundable dividend tax when you declare a taxable dividend to your personal name. And the other 50% that's non-taxable, you can just take out from the corporation tax-free after you file the capital gain dividend form.
That was awesome. Thank you, Cherry. I know we didn't get a chance to answer everybody's questions, and I hope that people will reach out and certainly follow you and all your social media. I think some of the questions that were being asked, I've seen that you've actually, like, somewhere in your blog, or you've done, you know, you've shared an article or something along those lines. And certainly the quality of the information you put out and the way you make it so easy for us as investors to absorb is phenomenal. We can't thank you enough for that, because I don't know about you. Well, you're obviously an accountant, but for me, it's like learning about insurance. Like it's almost another language. So I appreciate the way you make it so easy for us to understand.
Well, thanks so much for having me. It is a lot of fun sharing the same like these ideas with people. My mission is to hopefully simplify it enough so that people can understand.
Absolutely. We appreciate that so much. And I want to be respectful of everybody's time. Thank you so much for joining us today. If you are not already a member of my Facebook groups, please reach out on Facebook and join the conversation. And obviously you have Cherry Chan's contact info, which has been great. If you're looking for me, you can find me online as well, either via Instagram or YouTube, of course. And then I also have a website with some more information on my services and how I can help real estate investors. My next webinar coming up is going to be Bill Allen. And for those of you who don't know Bill Allen, he started a company. I don't think he started. He runs a company in the US called 7-Figure Flipping. And he is absolutely dedicated to helping real estate investors who want to learn how to do flipping and wholesaling, not just kind of dabbling a little bit, but actually turn it into a high performance business. So for example, most of you who are in that space would probably recognize the name Luke Boyron, who is an active member of 7-Figure Flipping and actually received a huge award last year. So Bill Allen's going to be joining us on Monday, February 28th at 7 p.m. And we're going to be talking about how to flip like a pro. Thank you again, Cherry, for your time today. Thank you so much, everyone, for attending. I hope you all got as much out of this as I did. Recording will be sent out via email to you by the end of the week, and it will go up on YouTube probably early next week, or the end of the following week. Have a fantastic Valentine's Day, everybody. Take care. We'll talk to you and see you all again soon. Bye-bye.
Thank you. Bye.